Welcome to our comprehensive USD/CAD analysis report covering the trading week of October 6th through 11th, 2025. In this presentation, we'll examine the key market dynamics that shape the Canadian dollar's performance against the US dollar during this critical period. We'll explore technical levels, fundamental drivers, and provide actionable insights for traders and investors. This analysis draws from multiple authoritative sources including TradingView, investingLive, Action Forex, Forex.com, and DailyForex to give you a complete picture of the USD/CAD market landscape. Let's dive into the details. During the week ending October 10th, USD/CAD closed at 1.4024, marking a modest gain of 48 pips or 0.34%. The pair traded within a relatively tight 58 pip range, with the weekly high reaching 1.4034 and the low touching 1.3976. This consolidation reflects market indecision following the psychological break above 1.40. Key resistance now sits at the critical 1.4014 to 1.4017 cluster, which has proven difficult to overcome. On the support side, traders are watching 1.4000 as immediate support, with stronger backing at 1.3930. The 55-period simple moving average at 1.3800 provides additional technical support. Our multi-timeframe analysis reveals mixed signals across different time horizons. The hourly chart shows downside bias, while the 6-hour time frame remains neutral, suggesting short-term consolidation. However, both daily and weekly charts maintain upside bias, indicating the broader trend favors USD strength. The relative strength index stands at 65.90, approaching overbought territory but not yet extreme. The MACD indicator hovers near zero, reflecting the current consolidation phase. Critical resistance levels include 1.4791 as the medium-term top, 1.4312 as the 61.8% Fibonacci target, and the immediate 1.4014/7 cluster. Support levels to watch are 1.3930, 1.3725, and the 55-month EMA at 1.3542. Several significant developments influenced USD/CAD this week. In the United States, Delta Airlines CEO highlighted increasing consumer spending, particularly from high-end consumers, reinforcing the narrative of a resilient U.S. economy. Federal Reserve official Michael Barr emphasized caution, noting stronger spending and sticky inflation, which tempered expectations for aggressive rate cuts. Meanwhile, the University of Michigan Consumer Sentiment Index ticked down to 55.0, though elevated inflation expectations support the case for Fed vigilance. On the Canadian side, the September employment report delivered a major surprise, with 60,400 jobs added, far exceeding expectations and offsetting the previous month's loss. This strong data provided crucial support for the Canadian dollar. The week's price action was characterized by USD/CAD's successful breach of the psychologically important 1.40 level on Wednesday, marking the first time since May 2025. However, the pair struggled to maintain momentum above the critical 1.4014 to 1.4017 cluster resistance, indicating persistent seller presence at these levels. The 58 pip weekly range between 1.3976 and 1.4034 reflects healthy consolidation after the breakout. Friday's Canadian employment report, showing 60,400 jobs added, provided significant CAD support, causing the pair to retreat from weekly highs. The choppy intraday trading suggests the market is building a base for the next directional move, with traders awaiting additional fundamental catalysts. Looking ahead, we identify three potential scenarios. In the bullish case, a sustained break above the 1.4014/7 cluster resistance would target 1.42 initially, with secondary targets at 1.4312 and an extended target of 1.4791. This scenario would be driven by continued US dollar strength and hawkish Fed expectations. The bearish scenario requires a firm break below 1.3930 support, which would open the door to 1.3800, then 1.3725, and potentially the 55-month EMA at 1.3542. This would likely result from weak US data or a dovish Fed. Our base case expects continued choppy, range-bound trading between 1.3930 and 1.4034 as the market consolidates and awaits additional catalysts. Several risk factors could influence USD/CAD's direction in coming weeks. Upside risks include stronger than expected US economic data, a hawkish Federal Reserve maintaining higher rates for longer, weaker Canadian economic indicators, oil price weakness, and negative trade developments affecting Canadian exports. Downside risks encompass weaker US economic data, a dovish Federal Reserve signaling aggressive rate cuts, stronger Canadian employment and GDP growth, an oil price rally, and continued gold price strength benefiting the Canadian economy. Key events to monitor include U.S. non-farm payrolls, Federal Reserve and Bank of Canada meetings, employment reports, GDP releases, crude oil inventory reports, trade negotiation updates, and inflation data. Thank you for watching this analysis.